Hey guys, my name is Max Convexity. Thanks for tuning into my channel. Today's lecture is called What Do You Consider Risk? It's different from person to person. So today I wanted to kind of do a follow-up to my kindergarten video that I released the other day. I got a lot of great positive feedback from that video, but I did get a little feedback that accused me of being disingenuous, which of course was not my intent. You know, if I had said the NAV erosion was a myth and then asked you to buy my ebook or my spreadsheets, you know, that on NAV erosion, you know, then I could see that'd been somewhat insincere. Of course, I'm not selling anything. These are my true opinions. I don't stand to benefit from the stuff I'm saying is all I'm saying. The other thing is I'm kind of throwing a lifeline to all the NAV truthers out there. We're kind of agreeing, right? I mean, I didn't say that the NAV doesn't get crushed once a month. I just said it was the dividend coming out, didn't have anything to do with the erosion. The dividend equals decay. So a dividend's a good thing, decay's a bad thing, but still they're the same thing. But if you don't want that decay, just get a lower paying dividend stock or get one that doesn't pay a dividend and won't have any decay. So I'm agreeing with the folks out there that say YMAX and Defiance have too much decay. Only I'm saying it's just because the dividend's too big. Or, no, I don't know, too big. It's so big. It's just like the Christmas analogy. I didn't say presents didn't show up under the tree on Christmas Day, right? I just said the man in the red suit didn't do it. That's, you know, the erosion is a myth, but it's not a myth that something's happening. So YMAX and Defiance have the highest dividend, so if going by my theory that dividend equals decay, they also have the highest decay, right? You could also call it depletion, but whatever you call it, I'm not trying to be disingenuous by just calling it a different name. If you don't want it, there's a simple way to prevent it. Like I say, just get a fund that doesn't pay a dividend, but if you still need some income, just get a fund that doesn't pay such a high dividend, and you won't have as much either. The dividend and the decay are one in the same thing. So to all those truthers out there that said Defiance has hella decay, yeah, I would agree. So does YMAX, so does any high yield ETF. And, you know, I was also trying to use this to illustrate a point. SCHD decays also, and we can quantify the amount of decay. It's whatever the dividend is. So think about this. Say SCHD pays a 3.5% dividend or something every year. So if SCHD paid that dividend and then the stock that they own didn't appreciate during the year, their NAV would be down 3.6%, right? And if you roll that forwards 10 years, they would be down 36% without any appreciation from the, you know, from the underlines. That's because you can't count on the appreciation. You have to normalize for that. You know, you have to look at how it would do without appreciation from the underlying. So SCHD over 10 years would decay about 30%. Now, you could say that SCHD doesn't have net decay because you're looking at the overall investment and it's easy for the underlines to go up at least 3%. Usually they go up a lot more than that. So, but you can quantify the decay. It's just the dividend. So you could say that FEPI has 9 times the decay that SCHD has. Decay, depletion, whatever you want to call it. Erosion, it doesn't matter. It's not erosion, but whatever you want to call it, there's 9 times as much of it as there is on SCHD. The reason FEPI is going to always look like it has more, or I guess it is going to have more, is because FEPI's underlines need to appreciate 27% to get people back to even from the dividend. I think they pay about 27%. Now, FEPI has good underlines, and, you know, in a good year doesn't have any problem appreciating well more than that. But, you know, every fund that pays a dividend kind of starts in the hole because the dividend is the amount that they have to, that their assets have to make up for them not to have any net decay. I would agree that Defiance is more likely to have decay than SCHD by the simple fact that Defiance has to go up 30% you know, or more to be even on the year. Look at IWMY. If the Russell is not up, because it's paying around 60%. If the Russell's not up 60% this year, they're gonna have some NAV, you know, depreciation, right? Because it has to come out of somewhere. Remember Max's math. Total return equals dividend return plus NAV return, right? You could also just call it this. Forget about dividend return. Just call it total return equals decay plus NAV return, right? So in IWMY's case, it has 60% decay, we'll call it. All right, so it has 60% decay. Let's say that the IWMY this year's up 30%. So let's say the total return of the fund, we want to be up 30%. Well, for the total return to be up 30%, but you have 60% of decay, that means you're going to have to lose 30. That means the NAV return is going to be negative 30. You're going to lose a third of your NAV in order to make that happen. Now, if IWMY or Russell's up 60%, then in theory you wouldn't lose any of your NAV. The NAV could be straight steady, but you're asking for the NAV, the underlying assets of any dividend fund you have, you're asking them to be up at least as much as the dividend that is paid out. So these funds that pay a 60, 70, 100% dividend, if you pay 100% dividend, in theory, if the price of the underlying didn't move, they would decay to zero by the end of the year. You know, they wouldn't really go to zero, they'd reverse split. But I mean, I've never talked about free money. I mean, the theme of my channel is there is no free money. It'd be great if you could buy these funds that pay 50% and they really did, and you really were back to even in a year, because 50% plus 50% equals 100%, so you'd be back to even in 2 years, right? Well, you could if it wasn't for the math. If it wasn't for the total return equaling the dividend return plus the NAV return. So when you have a 50%, you know, dividend return, if the underlying's not up at least 50%, then that, whatever that stock is going to have a negative NAV return. It's just the way the math works out. It has to come from some bucket. They always talk about risk buckets or something. If a firm pays a 60% dividend, that money has to come out of another bucket. That bucket's some combination of total return and NAV return, usually NAV return. Okay, so who are these funds for? So first of all, they're for people that need income. Lots of times you'll see people that are in their 20s, you know, and 30s that have these funds on the internet, and that's fine. I mean, but I would say probably for those people, you know, it's probably not the best fund for those people, because they can still work, they still have years to save. Growth investments are your best friends, as everyone knows this, but I'm just going to reiterate, growth investments are your best friends when you're in your 20s and 30s. As you get in your 40s and 50s, you want to mix in some income with it, but growth investments are your best friends. So if you don't need income, don't get these. And I think a lot of people were tempted because maybe they didn't understand the math, and they saw the 50% and they thought, okay, I can be even in 2 years. I'm just going to get this, double my money, or, you know, or be even, and then the rest will be gravy. And like I say, that works as long as the underlying is also up more than 50% both of those years. So in other words, it doesn't usually work in practice. Even though they pay 50%, it's going to take you more like, let's see, let's think about that. All right, just for an example, let's look at QQQY this year and see what is realistic. So we know it's not realistic to double your money every 2 years, or to get your money back after 2 years, let's just say. What is realistic? Let's see what they are doing. Well, QQQY is up 10%. They've been out 6 months, so we'll just say they'll be up 20% on the year. So at this pace, what they're doing, what they've done this year, and they have had a hell of a good year, but if they stayed on this pace, they would be up 20%. That's total return. So it's not, even though they pay a 50% dividend, we're looking for like a 20% total return. Well, so if you have a 20% total return and a 50% dividend, what's the difference? Negative 30. So the NAV's going to be down 30%. At the same time, though, making 20% a year is huge. That total return, the rule of 72, that means that you'll double your money every 3.5 years given this rate of return, right? 20 goes into 72, 3.5 times. So it takes about 3.5 years to double your money. So you can't do it in 2 years like it would be if you made 50%. If the dividend was also the same as the total return, that would be great. And I think that's what a lot of people thought. But now that there's more education on the internet, I think pretty much everyone knows. Everyone has a pretty good handle. We disagree on what to call it, but we understand what it's doing. I think the main people these are for, I would say, is somebody that needs income. Maybe somebody that wants to, that has assets, that has a decent retirement, but their wife's working, and maybe they want their wife to be able to stay home. They can reallocate some of their assets, a little bit more than maybe you should. They can go from, putting 10% in these funds to putting 20% in these funds. If they had $1 million, retirement, a 401k with 20% in these funds, and all of a sudden, even with the depletion, decay, erosion, whatever you want to call it, even factoring that in, all of a sudden their wife can stay home from work. I think that's admirable. And there's other situations too. Wonder if somebody wants to go to semi-retirement and coach their kids' little league team, and they're in their 40s or something, and they just want to go down to working half weeks or something. There's all kinds of use cases. But so I would say needing income, we'll just say that's half of all people. Don't already have 20% in these, we'll say that's another half. So right there, half times a half is a fourth. So right there, that's only 1 in every 4 people. Folks who understand them, I'd say, is about 1 in every 10 people. So that means 4 times 10 is 40. That means 1 in every 40 people, these would be appropriate for, about 2.5% of the population. That's why I was saying on my show, I could have a lot bigger audience if I would just, give the standard answer and whatever, because there's a lot bigger audience of people out there that don't need these funds. So it'd be nice to I could have a channel that just dogs on these all day and probably have a lot more subscribers. Of course, that's not what it's all about. The other thing is, the real thing, the why I like these so much, why I'm always talking about them, is because I am a professional options trader. I know for a fact these work. I've charged people to do a lot. I've charged people a lot more than this to do the same thing for them when I was in wealth management. This is a good deal by any measure. And, if I'd been in commercial real estate all my life and I'd recently retired, I'd probably have a channel where I'd talk about which REITs were the best REITs to buy. Wonder if I'd worked in Chicago in a bond pit, trading bonds, and I knew everything about that kind of government fixed income, then my channel would be helping people to understand government fixed income. I can only help you to understand what I understand. And the big theme of my channel, besides that there's no free money, is also that the way these guys do options, where they sell options, these don't erode. These funds are accretive because they're using time value, putting it in their favor. We've talked about it a million times. But yes, not very many people need these. It is a small subset of investors, and those are my subscribers, and I appreciate each and every one of you guys. So let's talk about strategies to defend ourselves. Once we've accepted, maybe we don't agree on what to call it, but we accepted, what it is. The first defense is to drip. I say drip 2/3. Sylvia Jablonski was on Retire on Dividends show, and she said she can't tell you how much to drip, but she said she heard of people that were dripping 80%. She talks to people that were dripping 80%. And that's probably fine too. But I always get a comment, and after the last video where I got accused of being disingenuous, I also got accused of just being stupid to tell people to drip because you're paying taxes on sales. It's just, and the more I think about it, yeah, it is. I have to agree with the comment. It is crazy to drip, and it's tax inefficient and everything. So sometimes those comments get to me. But then the other day I was thinking about it, and I was thinking, well, is it really stupid to drip? I mean, really, is it stupid to drip? For years, it's people have been talking about whether it's right to drip or not. It's not just like it's a stupid decision out of hand. And so I just Googled on the internet, should you drip, to drip or not to drip? And most of the answers say yes. I mean, but there is good points on each side. But it's not just an out of hand, stupid thing to buy one of these and then drip 2/3 of it back into one of these. And I never said you had to put it back into one of these. You just can't spend it. It has to go into some other kind of appreciated asset. You could also take the 2/3 out of Tesla, and you could buy Tesla shares. That'd be a nice idea. You could take 2/3 of what you're earning from Tesla, and you could buy shares in anything. It doesn't matter what it is. The thing is, you have to keep that part in the investment, because when that part leaves the investment erodes and decays, and that's what we're trying to avoid, obviously. Of course, there's another solution, and I see a lot of people in the Discords I'm on that do this. They buy these funds, but they only buy them in the underlines that are the hottest. So right now they have MSTR, they have Coney, they have NVIDIA, and maybe they have Tesla because they bought it and they were bag holding or whatever. They're hoping Tesla turns around. My point is they try to concentrate the ones in the funds where they think they have the best appreciation, the best potential for appreciation. Because now that we know that you really, when you buy these funds, even though they aren't trading vehicles and you aren't supposed to use them like this, it is another defense to buy a fund in one of these ETFs that you expect to be up 50 or 100% over the next year. Because then it can support the NAV. I mean, it can support the dividend. The NAV can support the dividend. And of course, you can't, but I believe you can't time the market. I'm not saying to do that, but I'm saying a lot of people do indeed do that. And a lot of them are good at it. Maybe they're better at it than I am. But that's another defense, is just pick the best underline. That's why FEPI's done so well. FEPI's underline is 15 FANG stocks. It's not only FANG stocks, it's also stocks like Broadcom and Salesforce, and it's more like internet infrastructure stocks, and that the communication sector, and that sector has just been on absolute fire lately. Another solution is you could switch to dividend growth. They have dividend growth, like that's a whole nother thing where you try to pick, instead of picking companies that pay high dividends now, you try to pick companies that will pay high dividends and increase their dividends in the future. That's legit too. You could also switch to bond investing, or you could buy REITs. There's a ton of other ways out there. I never said this is the only way. This is the only way that I am qualified to talk about, because like I say, I wasn't in commercial real estate. I don't know about bonds. I don't have any good advice on bonds. The covered calls I have good advice on. So I'm trying to share the good advice that I do have with you guys and try to keep my mouth shut about the other advice. Okay, so here's where it's risk. So a lot of people think that QQQY is super risky. And I always disagree with them, but it's actually not even any riskier than QQQ. And then they argue it with me. But then when we hash it out, what they mean is, even if it doesn't go down as far, the fact that it's going to come back up slower is why it's riskier. They're worried about the upside, which is a legitimate worry. Even if I can convince somebody, because the QQQY, if NASDAQ's down, 10, well, I'll just say this: in October, when the NASDAQ was down 10%, QQQY was down less than 5%. JEPQ and some of the other funds were down like 7 or 8. The market was down 10. QQQY was down about half of what the market was down. So, but it didn't pop back up as fast. So it depends on where you see the risk. If you're worried about risk on the upside or risk on the downside. Really, when it comes down to it, the risk of SPYT and QQQY are about the same, and really SPYT is a little riskier because they don't pay as high of a dividend. Like I say, their dividend's 20, QQQY's dividend is 60. That's all we need to know. So QQQY has 3 times, whatever you want to call it, as much depletion, decay, erosion, whatever, as SPYT. But now SPYT paying 20%, or around 20%, we don't know, don't pay yet, has about, 6 or 7 times the erosion of an SCHD. So we just have to be aware of it and be sure that we've accounted for it. Let's look at, let's go over here to Option Strat, and let's check out how the SPYT profit box actually works. All right, let's look at my profit boxes, and let's look. Okay, so it's not really accurate to call this a profit box. This red box right here, this box is actually represents the spread that SPYT puts on. For instance, for Monday, they've sold the 52.40, so that's the bottom line of the box. The top line of the box is 52.55. That's the option they bought. All right, like I always tell you guys, anytime there's a sold option, even as part of a spread, the sold option strike is max profit. So max profit on the SPYT spread is 52.40. And anything above that is a loss, and actually above the top line is max loss. Now, under the bottom line is all profit, but SPYT works different than the profit box for QQQY. So let's look at it this way. So this is the spread that SPYT has on. Let's look at it this way. Okay, what SPYT has done, they're long like 6,700 shares of NASDAQ, or not NASDAQ, of SPY. Okay, so but what they've done is they've sold 6 contracts, 6 call spreads. Well, that covers 6,000 of the shares. SPX is 10 times the size of SPY. So when an SPX contract, one SPX contract is worth 1,000 SPY shares, where one SPY contract is worth 100 regular shares. It's a 10 times factor. So anyway, so these guys, I simulated it as close as I could. In Option Strat, you can't mix SPY and SPX, but I put in here as if I simulated it as close as they could. So these numbers should be close for Monday. So let's say the day goes nowhere on Monday. These guys make $2,300 on an unchanged day. Let's say the day goes down, but not more than 0.1%. These guys still make something. So that's where the edge comes in. It may not look like a huge edge, but the market not moving at all and you making something is a huge edge. This is an example of an option strategy that's accretive. This option strategy, it's earning time decay, and that's why that happens. When you buy options, it's the opposite situation. The market doesn't move, you lose money. Usually all that you put in, you usually lose 100% of your money. That's the decay or erosion. That's what, that's how that happens. Okay, so there's the built-in edge. Well, the other edge is they don't lose money right away. It has to go down. I know 0.1% doesn't seem like that far, but it adds up. But anyway, so but if the market does go down, let's say here, if we have it down 1% day, these guys with this SPYT strategy will lose $35,000. All right. If we have an up 1% day, though, they make $31,000. And the thing is, they make a lot more on days that go nowhere, too. So if you add in the days up and the days that are down, maybe they cancel out. Most of the days go nowhere, and they're making a few thousand here, a few hundred here, losing a little bit less than they otherwise would have. That's where the power of this comes in. But the spread itself doesn't really mean that much, because this fund, they want to blow out the spread. Doesn't really mean anything, because this is like any other long ETF. You just want to root for them to be up as much as possible. This is basically just like any other long ETF. They call this option an overlay, and that's a good way to think about it. It's just something that sits on top of it. It's a lot different. It's a lot different because this option, like I say, it's an overlay because you still need an underline. So they just buy SPY shares for the underline. When you sell puts are such a powerful thing. Selling a put is synthetically owning the underline. It at least gives you the economic exposure to owning the underline. As far as the up and down moves go, of course you don't get the dividend, but it replicates the exposure. So with a put, all you have to do is sell the put, and it's a combination of an income strategy and a synthetic underlying. When you jump over to the call side of the ledger, you have to own the stock or own a synthetic to be able to sell calls to make money off the call premiums. Okay, so but the box, the QQQY box means everything, because the box has more determination on how much money they make. But I will say this, in the triple QY box, the top line is the sold strike, and the top line is max profit for that strategy. That was just correct. The bottom line is the sold strike in the SPYT box. So the bottom line is the max profit, not for the strategy, it's the max profit for the spread. The strategy just wants the market to be as high as possible. All right, so let's look at, all right, so here is a triple QY trade loaded up for Monday. Just a second. Jackson, come here. My dog's wandering off. So the triple QY trade, they just sell the 65 delta put. Here it is. See, they get $2,100 for their trade, but it gives them the exposure to the underlying. So to make it equivalent, so there's SPYT's profit graph. There's triple. To make it equivalent, to compare apples and apples, we'll just say the funds are the same size. They would have to sell 6 of these. They would have to sell 6 of those. Okay, so now let's compare it. So we have a day that goes nowhere. Triple QY makes $2,900. Nice job. SPYT makes $1,800 or something. It makes a little bit less. Yeah, it makes a little bit less, $2,300. But you can start to see it. The reason it makes less is because it has uncapped upside. Both of them have to drop by more than 1/10 of a point before they start losing money. So they start with a little bit of a head start. These funds, they're both similar in that aspect, but the go nowhere price, you make about 50% more if the market goes nowhere with triple QI than you do with SPYT. SPYT is for people that put a premium on bullish markets and markets going up. If you think the market's going up, you would just want SPYT. If the risk of you of getting in one of these things is, they aren't going to go up as fast, yeah, definitely get SPYT. Compared to triple QI. Triple QI will do better on the downside. A lot of people don't believe me on that, but it will. It'll do a lot better on the downside. They'll do better than any of these funds on the downside. But the trade-off for that is it trades it off because in lack of upside capture and lack of upside total return. All right, so let's look at this. So the market's down 2%. Triple QI is down 48,000. And SPYT is down 72,000. SPYT is giving up some of its downside buffer in exchange for some upside capture. There's no right or wrong investment. For some people, triple QI is the right one. For some people, it's SPYT. For a lot of people, it's neither of them. But there's no right or wrong answer. They have different qualities, and I'm trying to just help to understand which qualities each one has, and try to help identify, for which use cases they work better in. There's plenty of good use cases for these, but there's also times these shouldn't be used at all. And I like to talk about all the cases that they could be used in, though. But there's plenty of cases, like you can see, about 39 out of every 40 people walking down the street don't even need to mess with these, based on my little back in the napkin computation I did back there on the second slide. these are right for about 1 out of every 40 people. So, and luckily, a lot of those people are listening to this channel, and I appreciate each and every one of you guys. Remember, this is not financial advice. Check anything that you hear me say with a real financial planner, not just somebody that plays one on YouTube. But it's always good to do that. Seriously, it's great for to get free advice, but just consider what you paid for it. It's probably worth about what you paid for it, right? But it's fun. Like Retire on Dividends is always saying, fun and entertainment. It's certainly for fun and entertainment. And I do believe it can be for education too, but you have to verify. Remember Ronald Reagan, he was talking about trusting the Russians back during the Cold War, and he said, I'm going to trust, but I'm going to verify. Trust but verify. So, of course, and I would expect everyone to do the same with me. Trust but verify. And it goes for anything you hear on the internet. All right, guys, you have a wonderful day. It's getting kind of cold here in Austin. I'm going to get back inside. See ya.